My name is David Stevenson. I'm a columnist for the Financial Times, for Investment Week and for Money Week. I'm going to talk a little bit in this interview with Alex Crooke from Henderson about the opportunities in equity markets and looking for both capital growth and dividend growth. Alex, now you manage a variety of funds, many of them investment trusts under the Henderson stable, and you've got a particular kind of focus on globally diversified equity, haven't you? With two particular areas that you're looking particularly at capital growth, but also equity income. Now, the changes in the pensions regime have come along, haven't they? And also the new ISA rules, and they've introduced greater flexibility for investors, and there might be many older investors now beginning to look at the whole equity space and looking at it as an income alternative. Is that right?
Yeah, I think some of the consequences of the reforms we've seen, both changing those rules, introducing higher ISA limits, and the unintended consequences of, cutting advice and fining banks for giving advice,
yes,
is likely to lead, I think, yes, definitely, to a lot more people managing their own pension funds actually and taking things into their own hands. And what that will lead to is definitely a focus on equities with dividends. I think that providing that level of income for people, ultimately for people's retirement, is going to be a key focus.
Traditionally, when people come to the retirement age, they tend to sort of default back into bonds as a form of income, stable, robust income. The level of income on bonds is very low. Is the real attraction of equity income that you are getting that hopefully growing source of dividends that's coming through from holding shares?
Yes, I think so. Over time, equities are a play on economic growth. Economic growth has its ups and downs, but over the longer term does tend to grow consistently at 2 or 3%. Dividends should grow a little bit quicker than that. The long-term history over 50 years shows us that equity dividends grow by 6%. So I think you're at this point in time, and for the next few years in my mind, you've got equities that yield 3-4%. It's nearly double what you get on some of the government bonds with that growth over time. And I think one has to look at it over that medium term and say, right, it's not, I'm not managing this for 2 years, 5 years. But certainly as you're approaching retirement, into the early phases of retirement, then yes, equities I think should fill a decent slug of people's savings.
One of the reasons many people, particularly older investors, may not have chosen equities in the past is because they're volatile. They can be volatile, they can go down.
Yeah.
How volatile can those dividend-orientated equities be, and what do you do as a fund manager to manage that?
Again, if you look back in history, the equity dividend-paying equities tend to be actually lower volatility than the market as a whole. Oddly, they actually provide a higher return as well. And we've found that if you look at some of the trusts I run, Henderson High Income, for instance, pays a very high level of dividends, looks for higher yielding shares with a little bit of growth, but the volatility in the underlying their portfolio has been much lower in the market. And so again, I think it's a case of trying to manage that within your portfolio, trying to have some utilities, some safer companies where you're going to see the dividends grow very steadily, not the highest growth, but it's that steady accumulation of the return that what we're after.
And with a small caveat to that will obviously be therefore that if you're diversified and you're a long-term investor over a sufficient time span, that volatility can work in your favour almost.
Yes, and again, markets do tend to recover as well. Yeah. You look at the charts and they go up and they go down. The key is not to get too spooked out in some of those times. I do think, though, we are entering a longer term phase of lower growth, but therefore lower volatility. And we're seeing that to some extent already beginning to play out certainly into bonds, and it'll flow into equities, in my opinion, as well.
Younger investors, a lot of the headlines have been about older investors and the pension changes, but as you quite rightly point out, the new ISA rules are going to benefit all investors, young and old. Younger investors may not traditionally have thought about equity income. They might have thought, I'll go for growth, capital gains. Is that hunt for capital gains a sensible one, or should they be actually thinking about equity income as well as a kind of a long-term part of their planning process?
Again, personally for me, it's a balance. I think the key is to find a balance. If you just go for all-out growth and technology, a lot of companies fail. Again, the focusing on dividends is quite powerful because it focuses on cash generation in companies, because dividends are cash being paid out. So you're focusing on a safer form of investment. So yes, concentrate on some growth, but look for companies that have enough cash generation to pay those dividends and then hopefully grow those dividends over time. Again, in Bankers Investment Trust, for instance, another fund that we manage, that's our strategy. So looking for capital growth and income growth combined in companies, and that's worked very well for us over the long term.
You mentioned those investment trusts. Are investment trusts a very suitable vehicle for this kind of long-term investment planning? And if they are suitable, particularly if you're going for a kind of dividend-based income, what is inherent in the structure of investment trusts that works to your favour as an investor?
Some of these investment trusts have been going for 125 years. They're certainly long-term. And I think that's quite nice in itself. It tells you they've been around, their strategies probably work, therefore in 30 years' time they'll still be around, I should think, as well, many of these trusts. So you've got the longevity. You've also got within the structure, what's quite nice is that these vehicles they're called closed end, but it means that they're not issuing share units to investors and withdrawal and redemption. So they can react more calmly in difficult market conditions. You're not having to sell assets when you might not want to.
And let's just explain that. In a sense, if you've got a unit trust, you do daily pricing, and then if there's
daily redemptions.
Absolutely. So if you've got a big tide.
Investors leave the market, then you have to, as a fund manager, I have to sell things when I might not want to. And so again, that closed nature structure works well for you. Also, you're allowed to retain a certain amount of income in every year. It's about 15%. So what I can then do is smooth dividends over time. So I can keep a little bit back in the good years, pay it out a little bit more when the years when dividend growth isn't so strong. So again, if you look at the income profile, Bankers Investment Trust has 47 years now of consecutively growing the dividend. Again, I think that's a good long-term sort of aim for these sort of trusts.
If you buy an investment trust, you can buy them for your pension plan and for your ISA scheme, can't you? Because I think sometimes people think when they look at their ISAs, they think of just unit trusts and stuff I can maybe get via a mainstream IFA. But you can absolutely buy investment trusts, aren't they? And they're quite straightforward. And they could sit inside a pension plan. Definitely.
All the common platforms now allow you to buy investment trusts. It's usually within the equity area. And again, they're increasingly more, I think, more apparent, more information is on them. The websites that we have, either with Henderson's or directly for the trust, have a lot of information about what the trust does, what it holds, its strategies, and those are the important things to look for.
And I think one of the things that's probably underestimated as well is that many investment trusts also can be quite cost effective, can't they? And you can save in them in a very cost effective way. And the charges tend to be quite reasonable.
I think so. Again, the charges are falling along the side, open-ended products falling as well. Again, the older traditional ones with those 100-year records tend to have much lower fees as well than average. Again, you've got a board of directors there, which is another advantage, and these directors are overseeing both the manager and keeping those costs down. So again, you've got another layer of oversight, which I think is quite useful in these vehicles.
And many of those directors, some of them are non-executive as well, so they act as genuine guardians for the investors.
And shareholders. Yeah. And again, you can look in the accounts, you can see it's a good indicator of whether they're committed as well. I would urge people to look at that.